204.
All right, so Chapter 5, Accounting for Merchandising Operations. On page 206 is where we're going to get started. And this chapter introduces a lot of details, a lot of information about inventory. And inventory is one of the most important assets that a company has because it's the asset that a merchandising company, which they talk about, is a company who basically buys merchandise and then resells it to customers. That is what they generate a lot of because that's what your business is selling stuff. So in order to sell stuff, you have to buy it from somebody else. And the assets that you buy and hold for resale are inventory. So inventory tends to be a big item. It's a repeat. There's a lot of purchases and sales of inventory. At the end of a year, it's a high volume that's gone through. And so accounting for that is a significant item. It also is something that affects both the balance sheet and the income statement because the inventory itself is a balance sheet item, whereas the cost of the inventory when you sell it becomes an expense, cost of goods sold on the income statement. So knowing how to record this and how to properly account for it is an important part of most companies. So I start off on page 206 talking about the difference between retailers and wholesalers. Again, merchandising companies buy an inventory from another company, usually a manufacturer, and then they turn around and resell it to customers. Retailers sell it directly to the end user, consumers, so think of a Walmart or a company like that we shop at. Wholesalers sell it to other companies, so maybe somebody would buy, well, beer is a good example, okay? Anheuser-Busch down in the valley, they have the big distributor, or the big brewery. They don't deliver their own beer to everybody. What they do is they sell it to wholesalers. Wholesalers go and pick it up in semis, and then they take it back to their warehouse, and then they put it on little trucks and take it out and sell it to the Quick Trips and the grocery stores and all the other places. So that would be an example of a wholesaler. It buys a product that's made from a manufacturer, then resells it to other retailers who ultimately then sell it to consumers. They all have to keep track of the inventory, okay? And they kind of talk through it and go through that. Cost of goods sold is the cost or expense of buying the inventory, but we don't expense it until we actually have a sale. So when we go through and we buy inventory, we don't debit an expense and credit cash, we debit an asset account because the inventory, as long as we hold it, is an asset we're going to use for the future. It's not till we actually have a sale and it legally transfers ownership to somebody else that we actually record the inventory asset going down or away and the expense of that item. And the expense is always recorded at cost. We record our inventory at historical cost. So that's kind of the overview of what inventory is. On page 207, they talk about the idea of the flow of cost. And that's where we're saying is we try to go through and we try to keep track of the cost. When we buy things, obviously when we're buying them, we have to keep track of them. We don't just buy things once a year, keep them, unless you have a really big warehouse. You don't keep them. You have to buy things and then you sell them and replace more. So that flow we have to keep track of. And there's two basic ways that we do that. There's something called perpetual inventory and there's something called periodic inventory. And perpetual inventory is where the company goes through and is continuously updating the amount of inventory for purchases and for sales. So at any given time, they know exactly how much is in their inventory on the accounting records because every time they sell something, they take it out of inventory. Every time they buy new inventory to replace that, they put it into inventory. So it's perpetually updated. Periodically, or periodic inventory is where we don't keep track of inventory every time we do a sale or purchase. Instead, what we do is we count it at the end of a period and see how much we had, hence the name periodic inventory. And at that time, then we go through and we determine what our ending inventory is, and we make adjustments to try to figure out how much we use during the period. Now, the disadvantage of periodic inventory, of course, is that you don't know what you have during the period. So you don't really know until you do a count what your income and your income statement and your balance sheet should be. The nice thing about it is it's easier to keep track of. It's not as much detail. Perpetual, the advantage of it, of course, is that you always know what your inventory balance is. You can look at your ledger and it's going to tell you exactly how much you should have in inventory. It's also going to tell you what your cost of goods sold is because you record your cost of goods sold when you do the sale of perpetual. The downside is that it takes a lot of time and effort to keep a perpetual inventory up because every time you do a purchase or a sale, you've got to keep track of adjusting your inventory. So think of a store that's a retail store and they're selling a lot of things during the day. They have hundreds of transactions a day. Well, with periodic, you don't worry about recording your inventory changes on those adjustments. You just do it once at the end of the month. But with Perpetual, every time you sell something, you sell a $15 item to this person and $200 worth of stuff to that person, you have to go through and adjust your inventory. So in the old days, before we had computers, most companies used periodic because Perpetual was just too much detail. Now in this day of electronics and barcoding and everything, more companies use Perpetual because it is an easy way to see how you're doing. It gives you better control as well. So we're going to learn both ways because they both are available in the accounting world. So they start off going through and looking at the perpetual inventory system, and they start on 210 with the entries. And what I'm going to do is I'm going to walk through the entries on the perpetual system for both a buyer and for a seller, because obviously when you have a transaction, you have it on both sides, right? And I don't know which one you're going to work for, so we're going to learn both of them. And so we're going to walk through the journal entries for the perpetual first, then we'll do the periodic at the end. There's an adjustment or an appendix that they have. And I found they've got really some nice summaries in this book. One of the things I found that I liked quite a bit, and then you can maybe follow along, is over on page 230. They actually have all the journal entries for both the perpetual and the periodic listed by buyer and seller. So you might want to follow along on that. I'm going to write them on the board and lay them out in a little different order, but that's a good summary for what we're going to be doing today. So the way we're going to set this up is I'm going to go through and I'm going to put the transaction, the date. I hope I have enough room here. I'm going to do the date, then I'm going to do the transaction. And then we're going to go through and we're going to keep track of this, and I'm going to do it for the perpetual first, and I want to make sure I do it. See, I think they do the buyer first. Is that the one? So, yeah, so they do the buyer first. So we're going to do the buyer's books. Buyer's records. Okay, and then we're going to do the seller's records. And the buyer in this case is SOC, if you're following along with the book. And then the seller is PW Audio. Name of the companies in the examples. So the first thing that happens is they go through and they say we had in the case of the buyer, we ordered something. We did a purchase order and we said, hey, we need to order some material. So they go through and they place an order. And so the order goes through and it's placed, and then one day a truckload of material shows up and they go, okay, well we have to record this. This is on May the 4th. So on May the 4th, for the buyer, SOC, what happens is we go through and we have a purchase. And we purchase on credit. So the amount of the purchase that they have was $3,800, so we have inventory. Let's do our debit and our credit. Inventory is increased, the asset, for $3,800, and then we go through and we have an account payable that we report. So that's pretty straightforward. We just bought something on account, we haven't paid for it yet. So we record that. Then they also talk about having freight cost. Now on page 211 they talk about what about the freight cost, who pays for that? So in this example we're going to do here, let's say that the freight costs are paid by the buyer. And so what's going to happen is the buyer is going to go through and on May 6th they get a bill for the amount of the freight. And it cost them $150, so they paid for this, that was the agreement. Well, they're going to go through and they're going to record that, but it's not an expense because the cost of getting your inventory in, the cost of checking your inventory, all those things are part of the cost of the inventory. So using the perpetual system, because that's what we're doing here is perpetual, we're actually going to go through and we're going to add that $150. Oops, already I'm lost. This is freight cost. We're going to add to inventory the amount for the $150 freight cost. So we're going to debit inventory. So it doesn't go to an expense because it was a cost to the buyer of getting the item to their store and putting it into their warehouse. And then the other side of that is they paid cash for it. That's what it says. So again, we're going to increase inventory for the cost of freight if we're the buyer. Then on the 8th, we're going through and we're looking at this stuff, and it says that they found out that they didn't like the information. They didn't like what they got. So what happens is we go through and we're going to return it. And the reason we're going to do that is because it wasn't the right item, or it wasn't the right part, or whatever. And our supplier gives us the ability to return unwanted freight or unwanted merchandise. So what we do on the 8th is we go through and we say, okay, we're going to ship it back. I don't know who's going to pay for it. They didn't talk about that. But we don't have it anymore, right? So if we don't have it, we're going to take it out of inventory because it's going to go back. I got to remember that this is my transaction column. I'm not used to that, am I? So purchase return. There we go. So now what we're going to do is we're going to take it out of inventory. So we're going to credit inventory. That's an asset account. So we're going to reduce it by doing a credit for $300. That's how much we returned. But we also don't owe that anymore, right? Because we bought it on credit up here. So if we don't owe it, we don't have that liability. So we're going to take the accounts payable and reduce that by the same amount. So that's a debit to accounts payable. And then finally, down here on May the 14th, looks like, so if I remember this, yes, we paid payment on account. So we went through and we paid. Now, they did something a little different here. The company that we do business with, PW Audio, wants to encourage us to pay our invoices quickly. And the way they do that is they give us something called a purchase discount. This is over on page 212. Okay? Now, what's a purchase discount? Well, basically they say, hey, if you send us the money early than you normally would, we'll discount, we'll give you a break. And so the terms that's usually set up is something that looks like this. They call it 210 net 30. That's usually what your payment terms are. And what that means is if you pay within 2 days,
no, 2%.
oh, sorry, if you pay within 10 days, there we go, you get a 2% discount. If you don't, then you pay the net amount in 30 days. So normally you have a period of time that your supplier allows you a grace period without charging you interest or giving you a bad time and maybe charging you some sort of a fee to pay your payment, because that's the way retail works. You get your merchandise in, you try to sell it, you get the cash. Once you get the cash, use the cash to pay back your payables. Okay? So usually you get 30 days. But if PW wants to get their money sooner, they might go to SOC and say, hey, if you pay it within 2 days, we're going to give you this discount. Now, should SOC, the buyer, take that discount? Yeah, this is actually a really good deal, okay? Because it doesn't sound like much. You say, well, that's just 2%. That's not a big deal. But here's the thing. It's not 2% for a whole year. It's 2% for how long? The difference between 10 days and 30 days. Because after all, you're going to pay in 30 days anyhow. They just want you to pay by the 10th day. So if you paid on the 10th day, you're really only paying 20 days early, right? Well, look at it this way. If there are 365 days in a year, right, and you're going to pay just 20 days early, how many periods is that going to be? It works out to be 18.25 periods. There are 18.25 periods of 20 days. Okay. You're getting 2% for each one of those, right? Because if you did this for every one of those, you'd get 2% 18 times. What's my number there? 36.5. That's a 36.5% annualized return. How many of you would like to put your money out somewhere where you could get guaranteed 36.5% annual return? Yeah, all of us, right? Put my hands up twice. So this is a really good deal if you are a buyer. As a matter of fact, you always want to take these. What happens if you don't have the money? Go to your bank and borrow, right? Because if you can go to your bank and borrow at 10% for 20 days, and then of course pay it back at the end, but if you can pay it back, then what happens is it still ends up being a better deal for you. So as a buyer, you always want to take advantage of purchase discounts. Now, how about sales discounts? That's going to be over here on the other side. We're going to talk about that. Is that such a good deal for the seller?
Marketing-wise.
Marketing-wise, it's a good deal, but from a financial standpoint, that's a pretty expensive way to get people to pay you early. So it's not such a good deal if you're on the seller side, but it's a great deal if you're on the buyer side. Okay. So those are purchase discounts, and that's how they're calculated. So 210, 2% discount if you pay within 10 days, or net 30. So if you can do that, try to take advantage of those. And that on an ongoing basis, if you're doing a lot of purchases, because that's what we do in retail, we do a lot of sales, a lot of purchases, this can add up to big bucks.
It goes up to 10% on some companies.
Some companies will give you 4, 5, 10. I mean, if they're really desperate, they're going to give you a higher interest rate. And here's the thing. They don't know how expensive this is, because if they did, they wouldn't do it. They really wouldn't, because they just think, sure, 10% discount.
Well, it's about cash flow too, right?
Yeah, this is helping them get their money. If they need their cash, they're getting their money 20 days faster, so they're getting their money from you quicker. So I understand why they're doing it. But that's an expensive. They'd be better off to go and borrow the money from a bank and just pay a rolling line of credit at 10% than to keep giving people 36%. So that's how the purchase discounts get calculated. So in this case, you're going, you know this because you took the accounting class. You're going, oh yeah, we're going to do this for sure, right? So we're going to go over here, we're going to say we're going to pay our account. And so of course the first thing we're going to do is we're no longer going to have the payable, right? And the payable now, remember, we had $3,800 that we had originally that we'd purchased, but we sent $300 back. So now the account payable that we owe is only going to be the difference, which is $3,500. So this is a debit. I'm kind of squeezing them together, but that's the debit side. So we have a debit of $3,500. And then we go through and we're going to send cash, but we're going to get a discount. So this was a discount that was what, a 2% discount, right? So if we have $3,500 we owe, which is what we came up with, times 2%, that means it's $70. So what we're going to do is we're going to go through, and here's the thing, this reduced the cost of our inventory, right? Because we got a discount. So if we were increasing inventory when we paid it in, or when we bought the inventory and we put the cost in, then we're going to reduce inventory because we aren't going to pay that much. So we're actually going to go through and we're going to do a credit to inventory for $70 because that reduced the cost of us buying our inventory. And then the difference is going to be how much cash we're going to send in. Pardon? 34, yeah. $3,430, that's the difference. So that's how much cash we sent. Okay? So that's what's happening if we're going through and we're using perpetual inventory and we are the buyer. Now on the other side, we got the seller, right? Same transactions are happening over here on the selling side. The just difference is now whenever you sold to them, now instead of a purchase, of course, you have a sale, right? So we're going to go through and we're going to sell it. So we're going to record, this is on credit, so we're not going to get paid yet. So this is the seller. So they're going to record accounts payable. Sorry. Accounts receivable. Switch sides here. So they're going to record the accounts receivable, and it's $3,800 because that's what they sold it for. And then they'll record sales, so they have sales revenue. Okay? But now, that's the sale. What else happened on their books? What do they not have anymore? Yeah, they don't have any inventory, right? They sold it. We just recorded the sale. But now we got to show that the asset that the seller had that was sitting out their inventory has gone away. So we're going to credit inventory to show the inventory going away because this is perpetual, so we always take it out of inventory when we sell it. Are we going to take it out at $3,800? No. Hopefully not.
No, at the cost, right?
Yeah, this is the retail price. For the seller, this is the retail, right? So the seller hopefully sells it at a higher price than they paid for it. If they bought it for $3,800 and they're selling it for $3,800, they're not going to be in business very long, right? They got to make some money. So what they do is they have to look back at what the cost was, and that's what we're going to get into when we get into the next chapter. But we have to go through and figure out what the cost is. So they go through and they tell you that the inventory account's going to go down by the amount of the cost of the inventory. And this worked out to be $2,400. That was what the cost was. That's what we paid for the items that we sold. So the inventory asset goes down, so it's a credit. We don't have it anymore. It's a cost of doing business, so we put it over here in an expense account called cost of goods sold. And this is an account that's going to go onto our income statement, the 2,400. So the seller has to record not only the sale at retail, but also has to record the inventory coming out at its cost. Okay, so that's one difference. Now let's go over here to the freight. Now in this example here this is where we were saying the buyer is going to sell it, or going to pay for it, okay? But let's take an example of where the seller agrees to pay the freight. That's not normally the case, but maybe the seller wants to make somebody happy. You know, they want to make sure that the customer is happy. So what they're going to do is they're going to go over, and they had the example, I think, on freight incurred by the seller. That was on page 211. And they're going to go out, and they're going to record the $150, or the $150. But here's the thing. They're going to put it in here, and they're going to call it something called freight out for $150, and then cash. Now this only happens, of course, if the buyer didn't pay it. You know, the freight company doesn't get paid by both sides. If they did, everybody would be a freight company, right? So what happens is the seller is going to go through and record the $150. This freight out is not part of the seller's inventory, okay? Because here's the thing. If you're buying inventory and you're having to pay for the freight for it to come in, that's part of the cost of getting your inventory. You add that to inventory. But if you're selling inventory and you're sending it out to a customer and you're paying for it, that's part of your selling cost. So that's not part of an inventory item. That's a marketing or selling cost, and it gets recorded as a selling expense. So freight out is an expense. So that's one thing that's a little different. It confuses people. If you're buying it and you're paying for freight, it gets added to your inventory because it's a part of the cost of getting your inventory to you, so you have it available. But if you're selling it and you're paying the freight, it's an expense because the cost of getting it to your customer doesn't have anything to do with the inventory. It has to do with the selling part. So that's one of the differences. The other thing that happened next was on the seller's books. They got this notice that their customer wasn't happy and they're going to return some items. Now, again, that's normal for that to occur. As a matter of fact, there's actually, they talk at the top of page 212, there's two different ways that can happen. You can have a purchase return or a purchase allowance. A purchase return accounts where you return things that have just been returned that are fine. They can be resold, but they weren't the right size, or the customer didn't have them, didn't need them, or something was wrong that the customer just didn't need the product. So it's just a straight return. An allowance is where you say the customer received something, but maybe it had a ding on it, or it was damaged, or maybe they didn't really want it, but they'll keep it, but they want you to give a discount. And you don't want them to return it, so what you do is you say, well, how about if we just give you a discount? We basically say, we'll knock off part of the price. If you knock off part of the price and they don't return it, it's a purchase allowance, and it becomes part of a cost of your business. But in this case, we're actually receiving the inventory back. It's actually being returned. So what's going to happen is it's going to come back to us. And so, let's see, where was I? Oops, okay. We have a sales return and allowance, okay, for this amount. So sales, return, and allowance. We put them both in the same account. And since it was at retail, we do put it back in. It was $300. That's what's going to go as a debit against this account. And they no longer owe us the money because they've returned the merchandise. So we're going to take it out of the account receivable because we don't expect them to pay us for things that they've returned. So that's return. But now, again, we're using perpetual inventory. And what do we have to do every time inventory goes up or down? We got to record something in inventory. So we just got some new stuff back, right? Or some old stuff, I should say, back. So what we got to do is we got to put it back in inventory. So now we go through and we're going to put the amount back into inventory. Are we going to put it back in at the 300? Again, hopefully we sold it for more than our cost. So they tell us conveniently that our cost was $140. So we're going to put it back in inventory. That's what it cost us. That 140 was out of the 2,400. That was our cost. And then it wasn't an expense like we originally thought, so we're going to take it out of the cost of goods sold. So again, with the perpetual inventory, we've got to go through and we've got to show the return of the inventory goods back in the warehouse. Just like the goods in the warehouse get put back on the shelf, the accountants have to put the cost back into the record for the inventory. Okay. And then finally we go through and we receive a payment. That's nice. So we know that our customer took the discount and I guess we haven't figured out how expensive that is, so we're happy. So we're going to show the cash that we got, which was $3,430. And then we're going to show that we no longer have an account receivable because the customer had paid us. And the difference, the account receivable we had was $3,800, and then we took out $300, so we have to make $3,500 go away. Otherwise, they'll still show that they owe us something. So the difference between that is what we call sales discount. And that actually gets adjusted against our sales amount. Okay, it's not an inventory item, it actually shows up, and when we get in our classified income statement, it actually shows up in the sales, for net sales. So that's what our entries look like. They're very similar, but you can see there's a few differences, right? Okay. So that's the perpetual inventory system. Hopefully I can squeeze this in here for the other one. So let's go over and do the same transactions, but now let's do it on the periodic. So this is perpetual. And the periodic, if you're following along, I think that goes back in the index at the back of the chapter where we start that. That's on page 228. Okay? So let's kind of set the same thing up. We'd have the same date, same transactions. I'm going to do it for the buyer. Buyer's records, who is SOP. And then over here, I'm going to do it for the seller's records. Or books, I should say books, I guess, which is PW Audio. So the first thing is we go through and we're going to have a sale, right? We already talked about that. That was the sale for the buyer, sorry, we're on the buyer side now. So we're going to have a purchase. So we're going to get some items in. So on the 4th, we received some stuff. But now what happens is, in a periodic, we're not going through and we're not doing adjustments to inventory, right? When are we going to adjust inventory? At the end of the period, when we count it and see how much it should be, then we adjust to that amount. So what do we do in the meantime? Do we just forget about it? No, we have to keep track of it, but we're not going to do an adjustment to the inventory account with every transaction. Instead, we're going to keep track of some of the transactions and use those to find our adjustment at the end. So when we buy the inventory, we still have to show that we received something, but what we do now is we put it in something called purchases. And every time we buy inventory, we're going to put it into the purchases account. And we're going to see when we get done here how that's then used to find any inventory periodic. So our purchases were $3,800. Yep, $3,800. Debit, credit. Well, that's going to be really tight here, isn't it?
You can do it.
I can do it. Whiteboard management skills, we learn, right? Okay, and then we're going to have the same thing. We have to pay it, so we didn't pay it, so we're going to have accounts payable. $3,800. So that looks the same. We come over here. We do the freight. The freight's exactly the same thing. There's no difference here. So we're going to pay the freight on the first example. So, oh wait, except I'm back on my account. Are we going to put it into freight? Are we going to put it in inventory? Do we do adjustments to inventory? No, we don't. Okay, but we got to keep track of it because it's part of our cost. So what we're going to do is we're going to go through and actually put it into another account, a new account called Freight In. And again, we're going to use that when we get to the end of the period. We're going to use that to adjust and find what our ending balance is. So the freight in is going to be $150. And then this is still cash because it's still going out. And then we go through and we have a return, same thing we had before. The purchase return, we got $300 worth of merchandise. That wasn't what we wanted, so we sent it back. The accounts payable is going to go away because we don't know the account payable. And that's for $300. But now again, we don't want to do anything to inventory. So what are we going to put that in? We have to keep track of what we returned.
Purchase.
We're going to do it in purchase returns and allowances. Okay, so we're going to have a purchase returns. And then finally we come down here on the bottom, and when we make the payment, we're going to have the same situation. We don't owe the $3,500, so accounts payable goes away because we paid the bill. But now, instead of putting it in inventory, we have another account. Because again, we're not doing anything with inventory. We're not putting debits and credits in inventory during the period. So we're going to put something in what we call purchase discounts. And the difference between those is still going to be the same amount of cash that we paid, $3,430. So that's our cash. So the big difference is here for the buyer between the perpetual and the periodic inventory, journal entries, is that we have new accounts here. We have a freight in account, we have a purchase return, and we have a purchase discount. So everywhere over here where we had an inventory, well, we had purchases. That was the big one. Okay. Everywhere over here we had an inventory account, we had to go through and use a different account. Now, how's it going to look different for the seller over here, PW Audio? Well, what they're going to go through and do, okay, is they're still going to go through and show that they had a sale, right? That didn't change. They're going to receive some money, so they have an account receivable. $3,800, and they had sales revenue for $3,800. Okay. But what's different? Are we making adjustments to inventory? Not using periodic. We're going to figure out an inventory at the end of the period, right? So what happens is we don't do an entry to show the reduction in inventory. So we don't do this. We don't have a cost of goods sold and a credit to inventory. We ignore it. We don't record the sale of inventory. We only record the sale at the retail price. That's a big difference. Okay. Then we go through, if we do the freight out's going to be pretty much the same. See, do they have that? Freight out expense. That's not going to affect our inventory because we said that's a selling expense. So freight out expense, $150, and cash, that was the same, no difference because it didn't affect inventory. Then we come down here on the 8th to our purchase returns. Well, what do we do with our purchase returns? Well, in this particular case, we had $300 that were sales returns and allowances, and $300 that came out of accounts receivable. This is part of our sales number. This is going to be adjusted out of sales. This doesn't affect our inventory. So this is going to be the sales returns and allowances for $300. And then our accounts receivable, because the customer is not going to owe it because they're returning the merchandise. So the retail side of it's exactly the same. But what's different is we aren't going to do any adjustment for the inventory. We're not going to put it back in inventory and take the cost of goods sold out because we've never put it into inventory, so we don't have to. We never took it out of the inventory here, so we don't have to put it back in. So we just don't do a transaction entry for the return to the inventory. And then we get down to the bottom, to the last date, the 14th, and then what's going to happen is we go through, and that entry is going to look pretty much the same. We're going to receive some cash. Our customer is going to pay us the $3,430 they owe us. We no longer have the accounts receivable. $3,500, and then the difference between that is the 70, and again that 70 is a sales discount. It's part of the cost of selling. So we record the same entry that we had there. Sales discount. So the big differences on the periodic, on the seller side, there's bigger differences here, okay, is that when we go through and we sell something, here on the Perpetual, we put the cost of goods sold in inventory here. Here we don't. There's no entry. Same thing down here when we go through and we have a return, there's no entry to show the inventory being adjusted. We're going to adjust that at the end when we do the periodic count. And then the other differences has to do with, see, accounts receivable, pretty much. Yep, that's pretty much it. Okay. So there's differences on both sides, buyer and seller, between the periodic and the perpetual. Now, you can start to see why the periodic is easier. There's just not as many entries, right? So you don't have as much to worry about. But at the same time, it also doesn't give you that update, because as you can tell from here, at any time during the month, if you're a buyer, you can see what you purchased, but you have no idea what you sold. So you really don't know where you are. Okay. So that is the advantage of the perpetual, is at any given time you can see on the books what your inventory is. Now, does that mean that you just ignore what's out in the warehouse? Now, we'll talk about control. One of the things you're going to want to do periodically is go and count it, right? You want to make sure that when you count it out there, what you have in the warehouse and what you're showing on the paper is the same. If you don't, you want to go investigate. Did you have shrinkage? Did you have loss? Did you have waste? Was there theft? Was it an accounting error? So you need to check them periodically. That's good internal control. That's from chapter 6, 5, 7. That's from chapter 7. But this is basically the journal entries that you go through and do. You can expect to be doing these journal entries on the test. Okay, and so what I'll do is I'll set it up. I don't know that you'll do all 4 sets, one for each for all of them, but definitely you should know both the buyer side and the seller side for perpetual, and the buyer side and the seller side for periodic. Okay. So those are the journal entries. A lot of stuff there. Okay. See, what else did I have? It kind of takes us over through here. Now, what I wanted to come back and look at now is over on page, I'm losing it here, over on page 227. Because like I said, right here, when we're doing perpetual, we know what our cost of goods sold is. Where is it here? We sold stuff right here. Okay. We know what our cost of goods sold is because we're keeping track of it. And we know what our inventory is. But over here, we don't know that. So what we have to do is we have to go through and we have to prepare a reconciliation at the end of the period. And that's what they talk about over here on page 227. So everybody good with this? Can I erase this? Again, this is all summarized on page 223. It's a really good chart. It's really handy for that. So let me go through and let me erase this part. So when we have a periodic inventory, we're going to go through and we're going to count it. Not all the time, at the end of most periods. Maybe not every month, that's a lot. But it may be twice a year, maybe quarterly, depends on how big an inventory it is. Definitely on an annual basis. So at some point we're going to go through and we're going to know what we had at the beginning of the period, because at the beginning of the period is when we last did our count. So what we're going to do is we're going to go through and we're going to have our beginning inventory. So we know that amount, that dollar amount, from the last time we did our count. Since that time, we know how much new stuff we've gotten, right? How do we know that? We've had these purchases, right? So what we're going to do is we're going to go through and we're going to add to that our purchases, okay? So we're going to add, I'm just going to cost of goods purchased. They do it that way, but I just like to do purchases. So we know how much we had, and we're going to add to that freight. And we're going to subtract from that purchase returns. We don't do it here, but that's what we would do, okay? And purchase discounts. So these all get netted into that number, okay? But hold that thought for now. And then what we're going to do is we're going to go through, and if we say, well, we know what we started with, beginning inventory, and we know what we added during the period, that must have been what we had that was goods available for sale. Right? We had that much to sell. But when we went through and we counted, we came up with a new number. This is our new ending inventory number that we just did from our periodic inventory where we went out and counted stuff. We're going to subtract that, and the difference must have been our cost of goods sold. If we know what we started with, We know the new stuff that came in, what we had available. When we go and count it, it's not there. We're assuming that it didn't spoil or waste. In our happy little accounting world we have in this class, we don't have any spoilage or waste or theft or anything like that. We just figured that it left, it must have gone out, it was a cost of goods sold. So what you do is you go through and you do this calculation at the end of each period using the information that you had from these accounts, and that's how you then come up with what your cost of goods sold and your ending inventory number is. So they actually have an example of that on the bottom of page 227, where they go through and they say you had beginning inventory of $36,000. So that's what you had at the beginning of the period. Then you had purchases, okay? Now you notice there they go through and they have their purchases. They subtract out the purchase allowance and the purchase discounts, like I said, okay? They don't have, oh, they add freight in at the bottom. I've seen it both ways. I don't care how you do it, okay? So they go through and you can see they add these two together, add the freight, add the purchases, and then they subtract, they add it to come up to this, and then they subtract out the discount, and that's fine. I'm just going to kind of show it at the detailed level, or the macro level here. So 36,000, and then you go through and your net purchases ended up being 320. And the 320,000, you add those two together, you said, you know, I had $356,000 worth of merchandise that was available. But it wasn't all there when I went out and counted. When I counted it, I only had $40,000 worth of merchandise that I could find in the warehouse. So the difference must have been the stuff that was gone, and the reason it was gone was because we sold it. So then what happens is this becomes your new ending balance for this period on your balance sheet. This becomes your cost of goods sold on your income statement. And then when you start your next accounting period, this becomes your new beginning balance. Now, just because I feel guilty about leaving this hanging, because I didn't leave enough room, I'm going to do this real quickly. Okay. So how do I find my cost of goods sold? Well, I go through and I have my purchases. And they tell us that was $325,000. Then I'm going to go through and I'm going to subtract, okay, my allowances, my purchase allowances and returns, because I didn't have to pay for those. So I take those out. That was $10,400. I also had a discount. I got a discount because I paid early, so that wasn't part of my cost. So I'm going to subtract out my purchase discounts. That's $6,800. And then I'm going to add what I had to pay to have it shipped to me, my freight in. Which in this example, the bottom of the page was $12,200. So when I add that all up, that gives me my net purchases, okay, we guess, or call it that, yeah. Cost of goods purchased, okay. So, purchases. And then that's going to be the $320,000. So, just so you're clear on how we got to that number. They show it more neatly in the stepped income statement on the bottom of the page there. So that's the way you want to set it up in a gap statement. But that's the theory behind it. Okay? So that's what you do. The only account that you're going to find purchases in is going to be which kind of inventory?
Periodic.
It's going to be the periodic. It's the only place it's going to show up. Okay. Get these sheets of paper out of the way. If you were doing a balance sheet, or sorry, an income statement, and you were doing the step and you went over to the cost of goods sold section, you wouldn't have this big long adjustment. You'd have one line. It would just say cost of goods sold if you were using perpetual inventory. Why? Because when you're doing perpetual, you're always increasing cost of goods sold every time you had a sale, right? So what happens is you just take that account, cost of goods sold, and that becomes one line on the income statement over on the perpetual inventory income statement. You're only going to have to do this big long cost of goods sold section if you're doing periodic, because this is where you figure out what your ending cost of goods sold and your ending balance was.
That's where it might have tricked me up.
Is that where it tripped you up?
It might have
Ah,
been.
yeah, because
where
you
they
won't,
were asking
you
for-
won't have all this on a perpetual inventory because it's just line item is cost of goods sold. This is only on the periodic inventory. Okay, good. That might have been it. So many places to get you tripped up on this stuff, right? And we haven't even got to LIFO, FIFO, and average cost yet. Okay. I think that's pretty much it on the merchandising inventory that I wanted to talk about. They do go over on page 218 and they talk about closing entries. I don't want to spend a long time on that, but basically we do go through and we close out all the temporary accounts. So on perpetual inventory, we're going to close out those sales returns, those sales discounts, those cost of goods sold, the freight out. All those expenses get closed because they're temporary. But we don't close the inventory account because it's a permanent account. It's a balance sheet account. So we don't do a close for perpetual on the inventory account, just the temporary accounts. However, if you go over and you look on page 231 where we were talking in the appendix about the periodic, that's a little trickier. We're still going to close out those sales returns and sales allowances and all that, but then we're also going to close out the purchases account. That's a temporary account. We're going to close out the freight in and all that, but here's the difference. You actually do close out the inventory account. And it looks a little confusing at first, but that's because you close out the beginning inventory amount. Because the beginning inventory that you had up here, you want it to go away because you're not using it anymore. So you close the beginning inventory out, and then you actually take out of income summary the ending inventory, and that becomes the new balance going forward, and it becomes the new permanent balance.
It's like redoing the retained earnings.
It's kind of, yeah, I guess you could say that. Kind of like redoing the retained
We're
earnings.
just resetting.
Yeah. So what we're doing is we're resetting the incomes or the inventory amount, but we do that by actually closing the beginning inventory and then putting it into the ending inventory. Don't worry about that. I'm not going to actually close in entries, but just so you'll know, these do get closed out. Okay. So I think that wraps up the inventory part. Now they did go over and talk about the income statements, and we kind of already touched a little bit on that. There's two types of inventory or income statements. There's the single step, and then there's the multiple step. Most companies use the multiple step, bigger companies, because it provides more information. And basically the multiple step is just that. It breaks the information into multiple steps where you can see how the company is doing in different categories. If you look over on page 222, you can see at the top they have the sales section. I want to write this up here. Yeah, let's do it. Let's do a real simple paraphrase. What you're going to do is you're going to go through and you're going to start all these with sales, right? It's an income statement after all. Income's always driven by sales. But what we do on a multi-step is we go through and we put sales, and then we do go through and make adjustments for the returns. We take those out. Discounts, we take those out. So you would subtract those, and that's going to give you net sales. So we're going to do sales. Then we're going to do, I'm just going to do real quickly, sales returns and sales discounts. So those get taken out, and those come down to net sales. Okay, I'm not going to put the numbers, I'm just going to show you how it flows. So that gives us our net sales. Then we come down, and you can see on page 222, they have the cost of goods sold. Now they only have one line item there, one number. That tells you what kind of inventory they're using. Perpetual. The perpetual, you only have one line item because you're always updating your cost of goods sold. So whatever that balance is the right number. If we had a periodic statement, we'd go through and we'd have that whole thing where we start with beginning inventory and purchases and less ending inventory and cost of goods sold. But here?
You're not going to do that to us on the test.
No, I probably won't do that on the test. Okay.
Probably.
Probably. I don't think so. I got enough stuff to bother you with inventory. I don't have to go through and hit you with the income statement, right?
Yeah.
So that's going to come out. That's going to be subtracted, okay? And then that's going to give us what we call gross profit, or gross margin in some cases, but it's gross profit. Now what's nice about this is this tells us how much money we made, how much profit we made on buying the inventory and then turning around and selling it to our customers. You hope that's a pretty big number, because if your business is buying stuff from companies and selling it to customers and you're not making a lot of profit, you're probably not going to be in business very long. So this tells us how profitable we are. As a matter of fact, the gross profit margin is one of the calculations that companies look at the most, investors and bankers look at. Are you making money when you sell a product? Okay, that's bottom line. But of course, there's other costs that we have to keep track of, right? Those are the costs of running our business or operating our business. And so from this, we're going to subtract what we call operating expenses. And they have a list of those. These are usually listed out, okay? But it's like your cost of running your business. It's your salaries and your wages for your employees. It's your utilities expense. It's the rent on your store. It's your depreciation on your equipment, your delivery truck, whatever it is. All the costs of running your advertising. So all those get subtracted. But they're the costs that relate to operating your business. And so what that ends up giving us is then what we call income from operations. And again, this is an important number because this tells us we were running our business last year. Did we make a profit running the business? If you don't have a profit or income from running the business, that's a problem. But then again, that doesn't mean that's all the expenses we had, because we had some other expenses that were going on, or maybe we had other revenue. And that's what we call, they actually have it on the top of, where they have that, 222. They actually have that listed on, the top of page 222, other revenues and gains and other expenses and losses. What would some of those be? Well, you might get some interest revenue, because maybe people owe you money, so you get some income from interest. That's not part of your operation, so that doesn't go there. You might get dividends, because you own stock in another company. They pay dividends. You might get rent income, because you have a building and you own the building, but you're subleasing part of it to a co-tenant, and so you're receiving rent. Those aren't part of running your business. So we put those in what we call other revenue. So we're going to add those. And they're put down here because we don't want to add those to our operations, because if we put them up here in our sales, it makes our sales look higher than they really are. You also have expenses. You have other expenses that you have to pay that aren't part of running your business. You're going, well, wait a minute. What would that be? Others. Well, that might be, a big one is interest expense. Borrowing money. You had to borrow money from the bank for a loan. Well, that's not you say, well, that's a part of a cost of running my business. Yeah, it is, but it's a part of the cost of financing your business. Other companies might run the business the same way and not have to borrow money. So if you just put that into your operating expenses, and then a banker wanted to compare your income from operations to a company who didn't have interest expense, then it wouldn't really be comparable. And we want to make sure that these are usable for financial statement people. So what we do is we break things like interest expense out and put it down below, because it's a financing cost, not a cost of operating or running your business on a day-to-day basis. What happens if we have a casualty loss? We had a limb fall off in the winds, in Santa Ana winds, and hit our building, and our insurance wasn't up to speed, so we had to pay $10,000 to repair the roof out of our own pocket. That's not an operating cost. It doesn't happen all the time. So that comes out of here. So those types of things are what we put down in this area, because we want to have income from operations, kind of see how we're doing running our business. But all of these do ultimately come down and help us figure out if we ended up with a net income, right, or not. And they don't go through and show it on their statement, but taxes are part of it too, so you're probably going to have a tax line down below this, okay? But this is what a multi-step financial or income statement does. It lets you see how we doing just buying and selling our merchandise by itself at the gross basis. Then how much is it costing us to operate and run our business on a day-to-day basis. And then finally, if we have other stuff going on, how's that affecting us? All this is part of our net income. But it lets us see different pieces. It gives us more visibility. It's more work, but it gives us more visibility. Now, a single statement is just what it says, or single step is exactly what it says. You have everything basically in one place. So what happens is you go through and you have your revenues, and then you have your expenses. And so what we do is we put all the revenues over here in the revenues. So we just put our sales, we'll make it easy. We put any income that we have, other revenues. What else do we have? If we had any gains, we put that there. Our expenses we put over here. That's going to include our cost of goods sold. It's going to include all of our operating expenses. And it's also going to include any other expenses we have, like interest expense. And then the difference between those, we subtract all of these, obviously, gives us our net income. So it's simpler, but you can see it's not going to give you as much information about how you're doing. It doesn't let you see, for example, if we didn't have as much net income, we had a loss, do we have a loss because we're not selling our products at a high enough gross margin, profit margin, or because we had too many operating expenses, or because we had something else to hit us? This lets us see where the problem is. This just kind of lumps it all together. But simple companies, small companies often use the single step because it is easier to calculate. But most companies you're going to see are going to be using the multi-step. A lot in this chapter, huh? Yeah, a lot to it. So I think that's pretty much all the detail I wanted to go through. Again, on the test, what I would really focus on are the journal entries. Making sure that you know how to go through and record transactions on both the buyer and the seller side for both perpetual and periodic inventory. That little calculation we did for the cost of goods sold, that's probably something that you should be prepared to be able to go through and do. You should be familiar with this, but look at the announcement. I'm going to put out a study tips. Look at the announcement. I'll tell you if you need to do this or not. Because I'm thinking this is good to know, but I'm thinking that might be too much. Okay, so, but you should know this. Okay, all right.
Well, there's a difference between knowing it and memorizing it, and there lies the problem. I can go through it.
You can understand it, but writing it out from memory.
Well, like a balance sheet, I don't necessarily know how. All I have to do is make sure the two amounts match up by going through the,
Here's the thing. If I gave you this problem, I would give you all the counts, and all you needed to do was just take it. It's like a jigsaw puzzle.
Yeah.
I'm going to give it to you all scrambled up, and you just need to know how to put it into the order. That's all it would be. So, and that only if I tell you, you need to worry about that. So, if I tell you in the study tips, so check that.